Treasury yields have spiked over the past couple months, but in the very near term, we think yields could back up here. Hi, I'm Mark Arbeter, and this is S&P's Chart Room. Taking a look at a weekly chart of the 10-year Treasury yield, we've completed this fairly large inverse head and shoulders formation. Left shoulder head, right shoulder was very abbreviated. Treasury yields were certainly being held down by the Fed. It's like when you used to go swimming as a youngster and pushing a ball down below the water. Eventually the ball pops. Well, that's what we saw with Treasury yields as they popped through key chart support at 240, completing this fairly large base. Yesterday we ran up to significant trendline support. This support goes all the way back to the peak when rates were just above 5% back in 2007. So we think this support could keep a lid on Treasury yields here in the near term, and we do think yields could back up here. The first area of resistance would be about the 240 level, and then we think we'll probably break down through there a little bit and potentially go as far as the 2-1 area, which is the next area of chart resistance. On the upside and from a longer term perspective, looking out at least 6 months to the end of the year, this base, this inverse head and shoulders base, was about 100 basis points. So we think we could get a measured move of 100 basis points from the breakout point up to about 3.4%. We also will note that there's major chart support right in that area, the 3.5, 3.6, 3.7 area from the last significant peak back in 2011. So in the near term, we think we could get a retracement. This is the inverse here. This is a 14-week RSI based on yields, but I inverted the scale. Basically, this 70 area should be 30, and this should be 70 up here. So basically, this is a 14-week RSI of prices. Prices are just the opposite of yields. You can see that prices have moved to a fairly oversold condition down below the 30 level. And we will note the last 4 times going back to 2007 that every time that Treasury prices got this oversold, back in 2011, in 2009, in 2008, and in 2007, we did see pretty decent rallies across the board in Treasuries. So that's another thing to consider. When looking at the commitment of traders data, the commercial hedgers, which is the smart money, has been moving back into Treasury futures. Their net futures positions have been increasing. While if you look at the small speculators or the dumb money, they've been moving out rather quickly of their futures positions. That combination, along with prices being oversold, we think will lead to some kind of decent rally in Treasuries. And the next move higher, we do not think will be as sharp as this. We think yields, over the rest of the year will probably move higher, but certainly not with the slope that we've seen over the past 2 months. We think that will be bullish for stocks. This latest move in Treasuries kind of scared people out of stocks, especially dividend-paying stocks. But we think we'll see a more grinding move higher in yields, which will allow the U.S. stock market to move to all-time highs sometime later this year. This has been Mark Arbeter with S&P's Chart Room.